Have you ever wondered why Singapore's stock market seems to get the chills every time the US and China start arguing? Maybe you've heard that trade wars are just big country problems and don't really affect us here. Or maybe you've noticed your portfolio taking a hit and thought, wait, what does this have to do with me? Here's the thing. Most people think global trade wars are just headlines for economists and politicians. But what if I told you that the US-China trade war is like a traffic jam on Orchard Road, blocking not just the big players, but everyone else too? And yes, that means you, me, and every Singapore investor. Today, I want to break down exactly what's happening between the US and China, why it matters for us in Singapore, and how you can protect your investments. We'll look at the numbers, the sectors getting hit, and most importantly, practical steps you can take right now. I'll also share some analogies and stories to make the big picture clear, even if you've never followed global economics before. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Let's dive into what's happening right now. The US and China are slapping tariffs on each other's goods like it's a game of ping pong, but with real money and jobs at stake. In the past few months, tariffs have jumped to eye-watering levels, up to 125% on both sides. But what does that mean in real numbers? Trade between the two giants is falling fast. That means less business for companies, fewer jobs, and more uncertainty for everyone, including us in Singapore. Have you ever noticed how a slowdown in the US or China seems to ripple through our markets here almost overnight? That's not a coincidence. Many Singapore companies, like those in electronics, shipping, and logistics, are part of the global supply chain. When the US and China fight, costs go up and profits go down. The US stock market has dropped over 4% since January 2025. When Wall Street sneezes, the Singapore market often catches a cold. The Singapore dollar tends to strengthen when global uncertainty rises, which can hurt exporters here. And when big investors get nervous, they pull money out of risky assets, including Asian stocks and bonds. Think of the global economy as a giant spider web. If you pluck one strand, like US-China trade, vibrations are felt everywhere, including right here in Singapore. Imagine a chart showing a steady decline in US-China trade from $60 billion a month in 2023 to $50 billion a month in early 2025. Trade is shrinking fast. This isn't just a headline, it's a real economic shock, including Asian stocks and bonds. So what's driving this decline? Both countries have imposed tariffs as high as 125% on each other's goods. China has added US companies to its export control list, making it harder for them to do business there. The US is threatening to delist Chinese companies from US stock exchanges, and China is making it harder for US firms to operate. Companies are scrambling to move production out of China, but that takes time and money. If you were running a business, how easy would it be to move your entire supply chain overnight? Not very, right? That's why these shocks linger. Let's look at which sectors are feeling the pain the most. In technology, tariffs on hardware are hitting companies like Apple and semiconductor firms. In agriculture, US exports to China are down and prices are falling, which hurts US farmers and global food traders. Travel and education are also affected, with fewer Chinese tourists and students in the US, impacting airlines and universities. Manufacturing is seeing supply chain disruptions and higher costs, which hits electronics and consumer goods. Take Singapore's electronics sector as an example. If a US company can't get cheap parts from China, they might delay orders or pay more. That hits local manufacturers and logistics firms here. The US stock market is down about 4% since the start of 2025, after peaking in February. Tech stocks like Apple are under pressure, even though some have tariff exemptions for now. The Hang Seng in Hong Kong rebounded a bit, but volatility remains high as investors worry about more shocks. The Singapore market has been choppy, with exporters and manufacturers feeling the heat. Ever checked your portfolio and wonder why your REITs or blue chips are suddenly in the red? Sometimes it's not about what's happening here, but what's shaking up markets overseas. Here's how the economic impact unfolds. Tariffs are imposed, trade volume drops, company profits fall, jobs are lost, consumer prices rise, and market volatility increases. The big risks ahead include more tariffs or new bans hitting tech and finance, supply chains taking years to adjust, and the possibility of the US delisting Chinese companies, which could mean global investors lose billions. Singapore's open economy means we feel the pain faster than most. Sometimes the biggest risks are the ones you can't see coming, like a sudden policy change or a new round of tariffs announced overnight. So what can you do to protect your portfolio? First, diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across sectors and regions. Consider adding defensive stocks like utilities or healthcare that do well even in tough times. If you're heavy on tech or manufacturing, think about adding some local REITs or global consumer staples. These tend to be less volatile during trade wars. Second, watch for bargains, but be picky. Some stocks may look cheap after the sell-off, but check if their profits are at risk from tariffs or supply chain issues. It's like shopping during a sale. Not every discounted item is a good deal. Sometimes there's a reason it's on the clearance rack. Third, focus on quality and dividends. Companies with strong balance sheets and steady dividends are safer bets during uncertainty. Look for firms with low debt, stable cash flow, and a history of paying dividends even in tough years. Fourth, consider alternatives. Look at gold, bonds, or REITs as a hedge against market swings. Ever notice how gold prices spike when stocks tumble? That's because investors see it as a safe haven. Fifth, stay calm and stay informed. Trade wars come and go. Don't panic sell. Instead, follow the news, review your portfolio, and make changes only if your long-term goals have changed. If you want more updates on global trends and how they affect your investments, make sure to subscribe and hit the bell icon so you never miss a video. Now, let's go back to our analogy. Imagine Orchard Road at rush hour. If two big buses, the US and China, block the road and refuse to move, everyone else gets stuck. Delivery trucks, taxis, and even cyclists are delayed. Until the buses sort things out, the jam will continue and everyone pays the price. So, what did we learn today? The US-China trade war isn't just a headline, it's a real risk for investors everywhere, especially in open economies like Singapore. We saw how shrinking trade, rising tariffs, and supply chain disruptions can ripple through our markets and portfolios. But we also learned that with the right strategy, diversification, quality picks, and staying informed, you can weather the storm and even find new opportunities. Remember, investing is a marathon, not a sprint. The markets will always have ups and downs, but your long-term plan is what matters most. If you found this video helpful, please hit the like button and share your thoughts in the comments. What's your biggest worry about the trade war? How are you adjusting your portfolio? I'd love to hear from you. And if you want to dive deeper, check out my video on how to build a crisis-proof portfolio for Singapore investors. It's packed with more tips and real-life examples to help you stay ahead. Thanks for watching. And as always, stay savvy, Iguana investors.